Baya, there is one truth every trader must learn. The market is never random. It may look random to the beginner. It may feel confusing to the emotional trader. It may look like noise to the man who enters without a plan. But beneath every candle, beneath every rise, beneath every fall, there is structure. And the trader who understands structure does not see chaos. He sees direction. He sees strength. He sees weakness. He sees where the crowd is trapped. He sees where the big money is waiting. Listen carefully. Most traders lose because they are trading candles. But professionals trade structure. A candle can lie. A breakout can deceive. An indicator can delay. A news headline can confuse. But market structure tells the story of price. And price is the final judge. Not your opinion. Not your hope. Not your fear. Not the signal you found online. Price. Price tells you who is winning. Buyers or sellers. And once you learn to read that battle clearly, you stop chasing the market like a desperate man. You begin trading like a calm professional. When I looked at the market, I did not ask, will this candle go up or down? That is the question of an amateur. I asked, what is the market trying today to tell me? Because price speaks. It speaks through higher highs. It speaks through higher lows. It speaks through lower highs. It speaks through lower lows. It speaks through failed breakouts. It speaks through sharp reversals. It speaks through slow pullbacks. It speaks through strong, impulsive moves. Market structure is simply the way price moves. That is all. Do not make it complicated. If price is making higher highs and higher lows, the market is in an uptrend. Buyers are in control. If price is making lower highs and lower lows, the market is in a downtrend. Sellers are in control. If price is moving sideways between support and resistance, the market is ranging. No side has complete control. This is the foundation. And yet most traders ignore it. They look for indicators. They look for secret patterns. They look for a perfect entry. But they do not understand the basic question, who is in control? If you cannot answer that question, you should not be in the trade. Because every trade is a battle between buyers and sellers. Your job is not to predict the future. Your job is to recognize which side has power right now. That is market structure. The market rewards alignment. When the structure is bullish, you should think like a buyer. When the structure is bearish, you should think like a seller. When the structure is unclear, you should think like a patient man. Most traders lose because they fight the structure. They see a strong uptrend and they try to short every small pullback. They see a strong downtrend and they try to buy every falling candle. They want to catch the top. They want to catch the bottom. But the market does not pay you for being early. It pays you for being right with risk under control. A strong trend can continue much longer than your emotions can survive. In an uptrend, price makes a high, pulls back, then makes a new high. That pullback is not always weakness. Sometimes it is simply the market breathing. In a downtrend, price makes a low, pulls back upward, then makes a new low. That bounce is not always strength. Sometimes it is only a trap before another fall. So before you enter any trade, ask, is price making higher highs and higher lows, or lower highs and lower lows? This one question can save you from many bad trades. A wise trader does not fight the river. He waits for the river to show its direction, then he moves with it. In a bullish market, buyers are stepping in with confidence. Every time price pulls back, buyers defend a higher level. This creates a higher low. Then price pushes above the previous high. This creates a higher high. That is the rhythm of an uptrend. Higher high, higher low, higher high, higher low. This rhythm tells you buyers are in control. But do not buy blindly. The beginner sees an uptrend and jumps in anywhere. The professional waits for the right place. He waits for price to pull back into an area of value. Maybe previous resistance has become support. Maybe price returns to a demand zone. Maybe price pulls back to a moving average. Maybe price retests a breakout level. The key is patience. You do not chase the high. You wait for the higher low, because the higher low is where the market often gives you a better risk. Let me give you an example. Imagine a stock moves from 50 to 60, then it pulls back to 55, then it rises again and breaks above 60, reaching 68. Now the structure is bullish. The market has created a higher high, but if you buy at 68, after the move has already happened, you may be buying late. The professional waits. He waits for price to pull back up. Price comes back towards 60 or 62, and buyers defend that area. A new higher low may form. That is where opportunity begins, not because you guessed, because structure gave you evidence. In a bearish market, Sellers are in control. Price falls, bounces, then falls again. Each bounce fails below the previous high. That creates a lower high. Then price breaks below the previous low. That creates a lower low. This is the rhythm of a downtrend. Lower low, lower high, lower low, lower high. Many traders lose because they cannot accept this rhythm. They see price falling and say, "It has dropped too much. It must go up now." But the market does not care what you think is too much. A falling market can keep falling. A weak market can become weaker. A low price does not mean value. Sometimes it means danger. In a downtrend, the professional does not rush to buy. He waits for rallies into resistance. He waits for weak bounces. He waits for the lower high. Because the lower high often tells you sellers are still in control. Example, price falls from 100 to 85. Then it bounces to 92. Then it falls again and breaks below 85. Now sellers have proven strength. If price later rallies back to buy T, 85 or 90 and fails, that may become a selling opportunity. Not because the trader hates the market, but because structure is bearish. He respects the direction. He respects the pressure. He respects the evidence. Not every market is trending. Sometimes the market is trapped. It moves sideways, up and down and up, no clear direction. This is called a range. In a range, buyers defend support. Sellers defend resistance. Price keeps moving between the two. This is where impatient traders get destroyed. They buy the top because candles look strong. Then price reverses. They sell the bottom because candles look weak. Then price bounces. The range is designed to punish emotional decisions. In a range, the middle is dangerous. The top is where sellers wait. The bottom is where buyers wait. The professional understands this. He does not chase in the middle. He waits for price to come to the edges, support, resistance, or he waits for a true breakout with confirmation. A range is not useless. A range is information. It tells you the market is building energy. The longer price stays in a range, the more powerful the breakout may become. But before the breakout, the market often creates T-brass, false breakout above resistance, false breakdown below support. This is where weak traders enter late and strong traders wait for confirmation. Now listen carefully. This is one of the most important parts of market structure. A break of structure happens when price breaks a key high or low. In an uptrend, price should keep making higher highs and higher lows. If price breaks below the previous higher low, that is a warning. Buyers may be losing control. In a downtrend, price should keep making lower lows and lower highs. If price breaks above the previous lower high, that is a warning. Sellers may be losing control. This is where many traders make a mistake. They think every break means instant reversal. A break of structure is not always a full reversal. Sometimes it is the start of a reversal. Sometimes it is only a deep pullback. Sometimes it is a trap. That is why you must watch what happens after the break. Does price break with strength? Does it close beyond the level? Does it retest and hold? Does momentum follow through? A real break of structure shows commitment. A weak break often fails. The market does not reward the trader who reacts blindly. It rewards the depurator who waits for proof. If structure breaks, pay attention, but do not panic. Let the market confirm. Before a trend reverses, the market often changes character. This means price begins behaving differently. In a strong uptrend, pullbacks are usually shallow and buyers return quickly. But then one day, price pulls back deeper than usual. The bounce becomes weaker. The next high struggles. The candles lose strength. That is a change of character. It does not mean you must short immediately. It means you must become alert. The market is whispering. Something is changing. In a downtrend, price may fall strongly for weeks. Every bounce gets sold. Then suddenly, price stops making clean lower lows. It begins holding support. It pushes above a lower high. It pulls back and refuses to fall. That is also a change of character. This is how trends often shift, not in one candle, but in behavior. The amateur waits for someone to tell him the trend changed. The professional sees the change in price action before the crowd understands it. He sees weakness appearing in strength. He sees strength appearing in weakness. That is market structure. Now we must talk about something many traders feed but do not understand: liquidity. Liquidity is where orders are waiting. Above previous highs, there are buy stops. Below previous lows, there are sell stops. Around obvious support and resistance, there are stop losses. The market often moves toward these areas. Why? Because large players need liquidity to enter and exit positions. This is why price often pushes above a high and then reverses. This is why price often breaks below a low and then bounces. The beginner sees a breakout. The professional asks, is this a real breakout or is the market taking liquidity? This is one of the biggest differences between a weak trader and a strong trader. Weak traders enter when price breaks an obvious level. Strong traders watch how price behaves after the break. If price breaks above resistance but immediately falls back below, buyers may be trapped. That is a failed breakout. If price breaks below support but immediately returns above, sellers may be trapped. That is a failed breakdown. The market loves to punish obvious thinking. So never trust the first move blindly. Wait for the reaction. Here is a simple method you can use. No confusion, no magic. No need for 20 indicators. Say BSOD 1, zoom out. Start with the higher time frame, daily, 4 hour, 1 hour. Do not begin on the smallest chart. Small charts create noise. Higher time frames show structure. Step 2, mark the major swing highs and swing lows. Not every candle, only the places where price clearly changed direction. Step 3, identify the current structure. Is price making higher highs and higher lows? Then structure is bullish. Is price making lower highs and lower lows? Then structure is bearish. Is price moving sideways? Then structure is ranging. Step 4, find the key level. In an uptrend, find the last higher low or breakout zone. In a downtrend, find the last lower high or breakdown zone. In a range, find support and resistance. Step 5, wait for price to return to a smart area. Do not chase. The market will tempt you to enter late. Do not obey temptation. Step 6, wait for confirmation. Rejection, strong close, failed breakout, failed breakdown, momentum shift, higher low forming, lower high forming. Step 7, manage risk. Your stop loss must be placed where your idea is wrong, not where your fear becomes uncomfortable. Step 8, take profit logically. Previous highs, previous west side, range edges, next liquidity zones. This is trading, simple, but not easy, because the method requires patience. And patience is rare. Imagine the market is moving upward. Price rises from 100 to 110, then pulls back to 105, then rises to 118, then pulls back to 112, then rises to 125. This is bullish structure, higher highs, higher lows. Buyers are in control. Now the beginner sees price at 125 and feels fear of missing out. He buys at the high, then price pulls back. He panics. He closes the trade. Then price goes up without him. This happens because he entered emotionally. The professional waits. He says, the structure is bullish, but I will not chase. He waits for price to pull back toward 118 or 112. He watches for buyers to step in. If price forms a higher low and begins moving upward again, he enters with a plan. His stop goes below the higher low. His target is the next high or next resistance. He is not guessing. He is trading structure. This is the difference. The amateur enters because he feels urgency. The professional enters because price gives evidence. Now imagine price is falling. It drops from 200 to 180, then bounces to 190, then drops to 170, then bounces to bias 82, then drops to 160. This is bearish structure. Lower lows, lower highs. Sellers are in control. The beginner sees price at 160 and thinks, it is too cheap. I should buy. But cheap can become cheaper. He buys. Price bounces a little. He feels smart. Then price falls again. He loses. The professional sees something different. He says, the structure is bearish. I will wait for a rally. Price bounces back toward 170 or 180. He watches for rejection. If price fails to break above the lower high and sellers return, he looks for a short trade. His stop goes above the lower high. His target is the previous low or next support. Again, he is not predicting. He is following structure. Most traders do not lose because structure is hard. They lose because emotion makes it hard. When they are in a trade, they stop seeing clearly. If they bought, they only look for bullish signs. If they sold, they only look for bearish signs. Their position becomes their opinion. That is dangerous. A professional trader has no loyalty to a trade. He is loyal only to the market. If structure is bullish, he respects buyers. If structure turns bearish, he respects sellers. If structure becomes unclear, he steps in PS back. This is emotional discipline. The market does not care how much you want to win. It does not care if you lost yesterday. It does not care if you need money. It only moves according to pressure. And pressure is shown in structure. So train yourself to ask objective questions. What was the last major high? What was the last major low? Did price break structure? Did price fail to break structure? Is the pullback strong or weak? Is momentum increasing or fading? These questions remove emotion. And trading without emotional control is nothing more than gambling. One of the greatest mistakes is entering in the middle of the range, the middle of the trend, the middle of the candle, the middle of nowhere. In the middle, risk is unclear. The stop is too far. The target is too close. Emotion is high. Patience is low. The professional avoids the middle. He wants price at a decision point, near support, near resistance, near a previous high, near a previous low, near a breakout retest, near a structure shift. This gives him a clear plan. A trade must have a place where the idea is wrong. Without that place, you cannot manage risk. And without risk management, you cannot survive. Do not trade because you are bored. Do not trade because candles are moving. Do not trade because someone online is excited. Trade only when structure gives you a clean opportunity. Let me tell you something important. You will not master market structure by memorizing definitions. You master it by watching price every day. You study charts. You mark highs and lows. You observe pullbacks. You watch breakouts fail. You watch support become resistance. You watch resistance become support. You learn how the market breathes. Slowly, your eyes change. At first, you see candles. Then you see swings. Then you see structure. Then you see emotion. Then you see opportunity. That is the path. Do not rush it. The market has destroyed many impatient men. It rewards the trader who can wait. So the next time you open a chart, do not ask, where can I enter? Ask, what is the structure? Who is in control? Where did price last change direction? Where are the trap traders? Where is the next decision point? Where is my risk? Where is my proof? If you can answer those questions, you are no longer trading blindly. You are reading the market. And once you can read the market, you no longer need to chase every signal. You become calm. You become selective. You become dangerous in the right way. Because the best trader is not the one who trades the most. The best trader is the one who waits for the market to reveal itself. Remember this, market structure is the skeleton of price. Without it, every candle looks confusing. With it, every move begins to make sense. Do not chase noise. Do not worship indicators. Do not fight the trend. Do not enter without proof. Study the highs, study the lows, study the breaks, study the failures, study the traps. And above all, study yourself. Because the market will show you structure, but only discipline will allow you to trade it. The market does not reward the loud trader. It rewards the patient one. It does not reward the excited trader. It rewards the prepared one. It does not reward the trader who wants to be right. It rewards the trader who knows when he is wrong. That is the only trading guide you will ever need. Read the structure. Respect the trend. Wait for the level. Demand confirmation. Control the risk. And let the market come to you.